We often chase the promise of diversification like a weary traveler seeking refuge from a storm. The idea that scattering our seeds across different fields will protect our harvest, especially when those fields are labeled alternative assets, can feel profoundly comforting. But what if that comfort is a mirage? Perhaps you felt the quiet hum of anxiety, or whisper that, despite all your efforts to diversify, some part of your portfolio remains shrouded in a fog you can't quite pierce. The frustration of complex instruments, the opaque nature of certain investments, the gnawing fear that a hidden fault line could suddenly appear, jeopardizing the very security you sought to build. This feeling of being inadequately informed, even after earnest searching, is a heavy burden, a weight on the spirit. Benjamin Graham, the wise elder of value investing, once laid down a foundational truth, a guiding star in the wilderness of markets. An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. This isn't just a definition, it's an invitation to intimacy with truth, a call to strip away the veils of assumption and truly see. When we turn to alternative assets, private equity, real estate funds, hedge funds, structured products, we often do so with the sacred intention of broadening our horizons, of truly diversifying beyond the familiar. Yet, how deeply do we truly analyze these hidden corners? Do we understand their underlying mechanisms, the liquidity constraints, the leverage structures that often lie beneath the surface? Is your diversified portfolio truly diversified, or have you perhaps unknowingly invited a Trojan horse into the walls of your financial fortress? Today, we step into that wilderness, not to fear it, but to understand its contours. We will uncover 6 critical risks within alternative assets, risks that, if left unexamined, can subtly yet powerfully deflate the very diversification you sought, turning perceived safety into systemic vulnerability. We are uncovering the hidden truths behind wealth accumulation, daring to look beyond the headlines to what's really driving the market. Don't just invest, understand the why behind every decision. Challenge the consensus, find your edge. We often cling to the notion that alternative assets are a tranquil harbor, a safe haven where the wild currents of the market cannot reach. This belief, deeply ingrained, promises a hedge against volatility, a quiet assurance that even when traditional markets falter, our diversified portfolio will stand firm. Yet, in the quiet moments, a different truth can emerge, a fear of financial loss that stems from this very assumption. What if the low correlation statistics we so carefully study are merely fair weather friends, numbers that hold true only when the sun shines? The reality is more nuanced, more challenging. During systemic shocks, a phenomenon known as correlation contagion can sweep through markets. Assets that once seemed independent, dancing to their own rhythm, suddenly converge, moving in lockstep, pulled by an unseen force. It's like a fleet of diversified ships, each designed for different waters, yet all moored to a single deep-sea anchor that drags them down together when the ocean floor shifts. The 2008 financial crisis laid bare this uncomfortable truth, revealing how the uncorrelated benefits of many alternative assets simply vanished, exposing portfolios to amplified, rather than reduced, risk. To truly discern the strength of your diversification, you must look beyond the surface. Consider a 3-step quantitative approach. First, stress test your portfolio by simulating historical crisis scenarios, allowing the echoes of past storms to reveal hidden vulnerabilities. Second, analyze conditional correlation coefficients, understanding how relationships between assets shift under different market conditions. Finally, employ tail risk metrics, such as value at risk and expected shortfall, to uncover the hidden sensitivities lurking in the extremes. The story of 2008 is not merely a tale of economic collapse. It is a profound lesson in independent thought and data-driven analysis, a testament to the power of questioning market sentiment. It reminds us that seemingly disparate investments can be tied to the same underlying economic currents, like those ships tethered to a common, unseen anchor. Is your portfolio truly prepared for the tempest, or does it harbor unforeseen connections that could deflate your diversification when you need it most? The notion of a liquidity premium in alternative assets often presents itself as an alluring promise. Lock up your capital for a while, and you'll be rewarded with higher returns. Yet, for many, this promise can feel like a philosophical wound, a questioning of the market's fundamental fairness. Is illiquidity truly a premium, or is it a profound risk to capital access, a hidden prison for your wealth? This common distortion trivializes illiquidity as a mere inconvenience, overlooking its true power to freeze your capital precisely when no opportunities beckon or urgent needs arise. The counterintuitive truth, often revealed in moments of market stress, is that this liquidity premium can swiftly evaporate, transforming into a harsh liquidity discount. What was once hailed as an advantage becomes a significant, often unquantifiable, liability. Imagine a prospector who finds a vein of gold only to realize it's embedded deep within a mountain too remote, too inaccessible to extract. The gold is there, but its value value is trapped, its potential unrealized. This aha moment of understanding a complex strategy, this rush of dopamine, can sometimes hinder truly empowered, data-driven decision-making, leading us to chase illiquid assets for perceived higher returns without fully grasping the chains that come with them. Benjamin Graham and David L. Dard, in their seminal work Security Analysis offered a profound path to mental healing through the margin of safety. This principle, typically applied to valuation, extends powerfully to liquidity. It demands not just a buffer in the price we pay, but a significant buffer in our access to capital. It compels us to understand the true cost of locking up our funds, to forensically analyze redemption clauses, and to assess the depth of secondary markets with a skeptical eye, not just a hopeful one. To escape the liquidity trap, we must embrace this deeper understanding. We must ask, what is the true, unvarnished cost of illiquidity in a crisis? Are we prepared for that cost, not just financially, but emotionally? Is your quest for diversification inadvertently building a beautiful, yet inescapable, prison for your capital? There's a silent distrust that can settle in the heart of an investor, fueled by the opaque and often exorbitant fee structures found in alternative investments. It's a feeling of being exploited rather than empowered, a gnawing suspicion that the promise of alpha is silently devoured by hidden costs. The myth persists that higher risk always equates to higher returns, and that active management in alternatives justifies any fee structure. But this narrative often obscures a harsher reality. Many alternatives fail to generate true alpha once their substantial management, performance, and operational fees are meticulously accounted for. This can lead to a shattered expectation, a profound disappointment when the promised alpha vanishes or even turns negative, revealing a severe drag on long-term compounding. It's like paying a king's ransom for a map, only to find it leads to a dried-up well. The allure of exclusivity, the perceived sophistication of alternative assets, can be a powerful cognitive and emotional factor, sabotaging our ability to critically analyze financial data. This aspirational pull often leads investors to tolerate fee structures that would be utterly unacceptable in traditional markets. To truly understand the genuine underlying mechanisms of fee erosion, we need a strategic finance technique, a three-step process of deconstruction. First, meticulously deconstruct the infamous 2and20 model, understanding every nuance of its calculation and impact. Second, calculate the true hurdle rate required for an alternative asset to generate net fee alpha, asking what raw return is needed just to break even after costs. Finally, perform a total expense ratio analysis, comparing it rigorously to passive benchmarks. This deeper analysis allows us to see beyond the glossy brochures and understand the true cost of entry. Are you genuinely earning a premium for the complexity and illiquidity, or are you simply enriching the managers? Is your pursuit of diversification inadvertently leading you to pay a steep price for an illusion of value rather than true wealth creation? The world of private alternative assets often presents a valuation mirage, a shimmering lake in the desert that, upon closer inspection, is merely an illusion. This can lead to a profound sense of investment inadequacy, an overwhelm from information overload without clear synthesis, especially concerning the subjective and infrequent valuation methods used. We are sold on valuation metrics in private markets, but this is a common distortion. Mark-to-model accounting and infrequent re-evaluations can mask underlying volatility or even permanent impairment, presenting a smooth, misleading picture of asset performance. The counterintuitive truth, starkly different from public markets, is that there is no real-time Mr. Market for private assets. Their reported values are often estimates, susceptible to managerial bias and optimistic assumptions, particularly during buoyant periods. It's a quiet ache when you realize the numbers you rely on are not hard facts, but carefully constructed narratives. Society, in its hustle for quick gains and perceived sophistication, has often distorted the image of the independent, data-driven investor, pushing us towards accepting these opaque valuations. To navigate this landscape, we must cultivate an independent critical financial mindset, a technique applicable not just to investing, but to daily life itself. Demand transparency on valuation methodologies. Understand the inputs and assumptions behind every reported net asset value. Most importantly, apply a discount for opacity to those reported NAVs, a practice akin to Benjamin Graham's tireless advocacy for understanding intrinsic value independent of market price. He understood that true value is discerned, not merely accepted. This isn't about distrusting every private valuation, but about nurturing a healthy skepticism, a discerning eye. Are you truly seeing the intrinsic value of your private assets, or are you gazing up on a mirage, a reflection designed to soothe rather than reveal? Is your diversification built on solid ground, or on the shifting sands of subjective estimates? There's a silent fear that can creep into an investor's heart, a distrust of financial authority, when one realizes that even the most sophisticated alternative investments harbor unique operational risks. These are risks beyond beyond market cycles, risks from fraud to mismanagement, often overlooked by mainstream analysis. The common distortion is to focus due diligence primarily on investment strategy and past returns, neglecting the critical importance of scrutinizing operational infrastructure, governance, and counterparty risks. This can lead to a shattered expectation, a profound disappointment. The very sophistication of alternative structures, ironically, often introduces new vectors for operational failure. Think of inadequate risk controls, poor cybersecurity, or even outright malfeasance. These are not market-driven losses. They are internal collapses that can lead to catastrophic losses independent of market performance. It's like building a magnificent house only to see it collapse not from a storm, but from a tremor in its own foundation. The fatal mistake of those seeking rigorously data-backed strategies is often an over-reliance on a manager's reputation without a deep dive into their operational robustness. History, unfortunately, offers stark lessons. Cases like the Madoff scandal vividly illustrate the devastating impact of operational lapses, reminding us that even the most trusted names can harbor deep, unseen flaws. This empowers us to develop a rigorous operational due diligence checklist that goes far beyond performance figures. It compels us to focus on audit quality, custodian reliability, and regulatory compliance with the same intensity we apply to financial models. To truly protect your wealth, you must ask, who is safeguarding my assets? What are the checks and balances in place? Is the operational foundation as robust as the investment strategy, or is it a hidden abyss waiting to swallow your diversification whole? We began this journey by questioning the very nature of diversification, especially when it comes to the alluring, yet often opaque, world of alternative assets. We have walked through the wilderness of unseen correlations, where seemingly independent assets converge in crisis, pulling your carefully constructed portfolio into the same storm. We've explored the liquidity trap, where the promise of a premium can turn into a prison for your capital, freezing your options precisely when flexibility is paramount. We've uncovered the fee avalanche, those hidden costs that silently devour your alpha, leaving you with shattered expectations. We then peered into the valuation mirage of private markets, where subjective estimates can obscure true value, demanding a critical and independent mindset to discern reality from illusion. Finally, we face the operational abyss, the unseen risks from mismanagement to malfeasance that can shatter a portfolio regardless of market performance. These 6 risks are not mere theoretical constructs. They are real forces that can deflate your diversification, turning perceived safety into systemic vulnerability. Warren Buffett, with his characteristic clarity, once offered a profound truth. Risk comes from not knowing what you're doing. This isn't a judgment. It's an invitation to deeper understanding. True diversification, then, is not simply about adding more assets to your portfolio. It is about intimately understanding the nature of the risks within each asset, and critically, how they interact with one another. It demands a rigorous, data-driven lens applied to all asset classes, especially those shrouded in complexity. Sustainable wealth accumulation and genuine financial mastery stem from this relentless critical thinking. It requires a commitment to understanding intrinsic value, to dissecting systemic risks, and above all, the courage to challenge conventional wisdom. It means refusing to blindly follow the herd into alternative promises without first stripping away the layers of illusion and seeking the unvarnished truth. As you step forward, remember this: the market whispers many promises, but only data-driven truth offers true solace. Will you choose to simply diversify, or will you choose to truly understand, to truly master the sacred art of wealth creation?